Hey everyone, this is Kirk here again at OptionOutfit.com, and thanks so much for checking out tonight's video tutorial where we go over all of our opening and closing or adjusting trades. So remember, if you're watching this video publicly on YouTube or somewhere else online, on our blog or on Facebook, you just have to understand that this video goes out about 10 to 15 days after these alerts and video are sent out to just our members. So you only get our alerts and you only get this video the same day of the alerts if you sign up on our website at optionalpha.com. So today we just have one lonely butterfly, and because we only have one trade to go over today, and that is that opening butterfly trade, I want to spend a little bit more time going over and kind of dissecting this thing, if you will, and understanding how we placed the trade, what the structure was, and where our profit and loss areas are on the Analyze tab. So kind of going back into the Thinkorswim platform and using that to see where we have some risk and where we can make money with this trade. Now you'll see that is a butterfly in CMG, which is Chipotle, and the expiration month that we're trading is the July 2014 monthly contract. So these are not front month, which is June, which only has about 2 weeks or so to go in expiration, 3 weeks to go in expiration, but we're trading the next month out, which is about 46 to 45 days out. Now you'll notice that this is a little bit different because this butterfly is a broken wing butterfly, and in the case of a broken wing butterfly, one side of the spread has strike prices that are uneven from the other side. So if we take our 540 strike to 555, you can see that that's a $15 wide strike, right? So the difference between them is $15. Now, if this was a very even or symmetrical butterfly, then this call side on the top would be 570, so another $15 higher. But it's not. This is actually $20 higher on the top side. So this is where we get that broken wing part of our butterfly spread. Now the reason that we do this is that we take in a credit by going out that extra call spread. So we are going to buy the 540, sell 2 of the 555s, and then go all the way out and buy a cheaper option. Instead of coming into 570, which is more expensive, we go a little bit further out in strike price and buy the 575 calls. And all of that totaled a nice little credit of $15. So it's not important to actually get the credit. The credit just reduces our downside risk on the trade. And that's really the biggest key factor or key point here with the broken wing butterflies, that if you trade, at least in this example, a call broken wing butterfly, then you want to take in a credit, which means that you have absolutely no downside risk, right? We would make 15 cents or $15 if Chipotle just crashed from here. And really, that's kind of where we think the risk is in this stock. So that's the particulars on how to actually execute the trade and how it's broken down. So let's go to the chart here first of Chipotle, and you can see why we entered this trade. You'll notice first that implied volatility was above the 50th percentile today. It's creeped right back under that level today here at the close, but it was above the 50th percentile, so it is a high implied volatility trade. And you'll see that Chipotle has just had a huge run, but it's starting to kind of fade, right? It doesn't have the steam that it had before, and it's starting to kind of roll over here. So we think that there could be some more room left in the stock to run, and so we've kind of centered everything anywhere between about 570 and down. So that's really where we have a lot of risk, is after 570. So we have left ourselves enough room for Chipotle to run up to 570, and obviously, like I said before, if Chipotle just continues to move down or crashes, at the very least, we'll make a $15 credit. So that's the way we're playing this. Even though it is a call butterfly, we're actually directionally bearish on Chipotle going forward, and we think that the stock could at least see a little bit of negative movement here in the next couple weeks. If we go to the Analyze tab, this is what our broken wing butterfly looks like. So again, if you remember, just a regular butterfly looks something like this, right? And I'm just going to draw it out, but it looks something like this, very even, very symmetrical on both sides. In this case, our broken wing butterfly starts off very equal, but then it has this broken wing. And like I said, we could have bought the 570 strikes, which is right here. But instead, we moved just a little bit further out, and that gave us this broken wing side of the spread where we bought the 575 calls instead. So this is the broken wing side of our trade. And now you can see that on the downside, we have absolutely no risk to the downside, and kind of have this area between, say, 540 and 570 to make money on this trade. So this is really the range that we want Chipotle to be in by July expiration to really make some good money on this trade. Now, if it goes outside of this range, obviously that's okay, and we obviously lose money in that case, but you'll notice that we actually have a very good risk to reward ratio, right? So we have a ton of money. We can make almost $1,500 if Chipotle closes right in the middle of our range, or about 555 where our short call spread is. So if it closes right there, we make about $1,500, and if it goes down even further than that or continues to go higher than that, then we lose about 485. So it's actually a pretty good risk reward for this trade, and given that the price level that we really have as a break even is 570, we're actually pretty comfortable with this trade. If I go in here to the trade tab just to show you guys where the trade is actually placed, and you can see it down below, we're just par on the day for the actual position. But let me scroll down here and you can see where the trade is actually placed. So here are the spreads that we traded. We bought the July 540, so you can see we bought that spread over here. We sold 2 of the 555s, which is just out of the money, so just above where Chipotle is trading right now is that short. So it's all premium that we sold, and we sold 2 of those, so that's what gets the kind of peak in that butterfly spread on the top side. Now what we did is, instead of going to the 570, which is again making it a very even butterfly, we skipped 1 strike and moved out to the 575. So what that did was that gave us a really, really good range to make some money, and also gave us a credit, right? Now we consider 570, like we just had looked at on our chart, as our break-even point. So even though we're long the 575, really we consider these 570 options as our break-even point. So if I continue to move over here even further, you can see that today that option had about a 75% chance of being in the money by expiration. So what does this mean? It means that there's about a 25% chance that we lose on this trade. There's about a 75% chance that we actually win on this trade anywhere between 570 and below, which is really our profit range, right? We make more money between 540 and 570, but we actually really win on this trade anywhere below 570. So this is a 75% probability of success trade. This is the type of trade that we want to consistently make on a daily basis. And if I can make enough of these trades, I'd actually be a pretty happy guy if we can make these trades all day long. So we're directionally bearish on Chipotle. Implied volatility was fairly high, so we went ahead and did a call broken wing butterfly. So as always, I hope you guys really enjoy these videos. If you have any comments or questions, please add them right below here. I'll get back to all of those tonight or tomorrow before the open, and happy trading.